If you're new to investing, ETFs are probably the first thing everyone told you to buy. The problem is no one really explains them clearly. You're in the right place. In this video, I'll explain exactly what ETFs are, how they work, and what you need to know before investing, so you can start with clarity and confidence. Let's start with the basics. What exactly is an ETF? To better understand what an ETF really is, think about a company and its clients. A business that depends on just one client is extremely risky. If that client leaves, the company's revenue can collapse overnight. Strong and stable companies work differently. They have many clients, each one representing only a small part of total revenue. If one client leaves, the business keeps running because the remaining clients help absorb that loss. This is the same logic behind an ETF. Instead of depending on a single company, an ETF gives you exposure to many companies at once. Each company represents a small part of the whole, which reduces the impact if one of them performs badly or even fails. This is the basic principle behind an ETF. So, an ETF stands for Exchange Traded Fund. In practice, it's a type of investment fund that is bought and sold on the stock exchange just like a regular share. The goal of an ETF is not to pick individual companies, but to replicate the performance of a reference index such as the S&P 500, a specific sector, a single asset like gold, or even a basket of different assets. When you buy an ETF instead of investing in one single company at a time, you're automatically investing in many companies at once. It's like buying small pieces of every company that belongs to that index in a single transaction. Each ETF follows a specific index, which works like a list of companies with clear and predefined rules. When you buy one unit of that ETF, you're buying a small portion of each company on that list. This helps spread risk across many companies, so if one of them performs badly, the overall impact on your investment is much smaller. That's why ETFs are often considered a simpler and more balanced way to invest in the stock market, especially for beginners who want to avoid unnecessary risk. Now that you understand the basic idea behind ETFs, let's look at the different types you can invest in. ETFs can include almost anything. If you can group assets together under a clear rule, you can build an ETF. In general, ETFs are divided into two main things: categories and types. Equity ETFs are the most common. They work like a basket filled with shares from different companies, and they can focus on a specific sector, a single country, or be globally diversified. Then there are bond ETFs. These are like baskets made up of different types of loans or bonds, and they usually aim for more stable and predictable returns compared to stocks. You also have commodity ETFs. These give exposure to raw materials such as gold, oil, or other commodities, either through physical holdings or instruments linked to their price. Finally, there are real estate ETFs. These provide exposure to the real estate market by investing in real estate companies or REITs, rather than owning properties directly. When it comes to types of ETFs, the difference usually comes down to how the assets are selected. Sector ETFs focus on companies from a specific industry, such as technology, healthcare, or energy. They're often used by investors who want more exposure to one particular part of the economy. Geographic ETFs, on the other hand, group companies based on location. These include ETFs that focus on a single country, like the United States, or on entire regions such as Europe or Asia. Finally, there are thematic ETFs. These are built around a specific idea or trend, like renewable energy, artificial intelligence, or cybersecurity, regardless of sector or geography. All of this helps you choose what to invest in. But this next point determines how your investment actually grows. One of the most important decisions when choosing an ETF is whether it is an accumulating or a distributing ETF. This difference is directly linked to dividends and to how you actually make money from your investments. In simple terms, there are two main ways to make money with stocks. The first is through dividends, which are paid regularly by companies to shareholders. The second is through price appreciation, when the value of the stock increases over time. In an accumulating ETF, the dividends paid by the underlying companies are not paid out to you. Instead, they are automatically reinvested back into the ETF itself. You don't need to do anything. The process happens automatically. This helps maximize long-term growth through compound interest because those dividends continue working inside the fund. In many countries, this also means you avoid paying dividend taxes immediately, which makes the growth more efficient over time. To know whether an ETF is accumulating or distributing, you just need to look at its name. It's usually labeled as ACC for accumulating or DIST for distributing. In a distributing ETF, dividends are paid out to your account on a regular basis. This can be attractive if you're looking for recurring income, but it also means you'll pay taxes on those dividends as soon as you receive them. Because of that, distributing ETFs are generally better suited for investors who prioritize regular income over long-term capital growth. Now let's talk about something that often confuses people at the beginning: the name of an ETF. At first glance, it can look complicated, but in reality, the name tells you almost everything you need to know. Let's use a concrete example. iShares MSCI World UCITS ETF USD ACC. Each part of the name has a specific meaning. iShares is simply the fund manager, meaning the company responsible for creating and managing the ETF. MSCI World indicates the index the ETF tracks. In this case, it's a list of companies from developed countries all around the world that the ETF aims to replicate. UCITS refers to European regulation. It means this ETF follows European Union rules, which is important in terms of protection for European investors. USD indicates the currency in which the ETF is traded on the stock exchange. And finally, ACC tells us this is an accumulating ETF, meaning dividends are automatically reinvested inside the fund. Once you understand this logic, reading an ETF name stops being confusing and becomes a quick way to know exactly what you're investing in. Another important thing to consider is ETF costs. All ETFs have management and maintenance costs because there are teams responsible for making sure the fund correctly tracks the index it follows. In general, the more complex or customized an ETF is, the higher its management cost tends to be. Very specific or thematic ETFs, or those with more complex strategies, require more work and therefore come with higher fees. On the other hand, simple ETFs that track large indexes, such as the S&P 500, usually have very low costs. In many cases, the management fee is around 0.07% per year. This means that for every 1,000 euros you invest, you pay about 70 cents per year in fees. These amounts may seem small, but they make a difference over the long term. That's why understanding costs is an essential part of choosing an ETF. Now that you understand the basics of what ETFs are, the natural question is, how do you choose the right ETF for you? The first step is knowing where to look for information. There are several specialized websites, such as Just ETF or Morningstar, where you can find almost everything about an ETF. On these platforms, you can check the product fact sheet, historical performance, ETF composition, associated costs, and other important details before investing. After that, there are some simple ratios worth paying attention to. One of the most important is the TER, or Total Expense Ratio, which represents the annual cost of the ETF. As a general rule, the lower the TER, the better, because less of your money is lost to fees over time. Another factor that often comes up is volatility, meaning how much the ETF's price fluctuates in the short term. However, if your goal is long-term investing, there's no need to stress too much about these fluctuations. Volatility is part of the market and tends to smooth out over time. This leads to an important rule: don't overcomplicate things. For most people, it makes more sense to start with broad, low-cost ETFs managed by large institutions. Don't try to guess what the ETF of the moment will be, because an ETF that invests in the entire world is already diversified by definition. To make this more concrete, let's look at an example. The Vanguard S&P 500 UCITS ETF, USD. Accumulating is one of the most popular ETFs for beginners who want simple exposure to the US stock market. It has a TER of 0.07% per year, uses physical replication, holds around 502 companies, and has been around since 2019. With a fund size of roughly 26 billion euros, it's a strong example of a simple, diversified, and cost-efficient ETF for long-term investing. Let's now take a look at two of the most well-known and widely used ETFs in the world. The first one is the S&P 500, also known as the Standard & Poor's 500. This is an index that tracks the 500 largest companies in the United States. To invest in this index, you don't buy the index directly, but rather an ETF that replicates it. Some examples of ETFs that track the S&P 500 include the Vanguard S&P 500 UCITS ETF, ACC, the iShares Core S&P 500 DIST, and the Vanguard S&P 500 ETF, DIST. The S&P 500 index was officially created in 1984, but since it reflects almost the entire US stock market, it's possible to analyze its performance well before that date using equivalent historical data. In practice, when you invest €1 in an ETF that tracks the S&P 500, that euro is spread across the 500 companies that make up the index. In terms of composition, the index has a strong exposure to the technology sector, which represents a significant portion of the total. This is where you find some of the largest companies in the US market, such as Apple, Meta, Nvidia, or Amazon. It's important to understand that in this type of index and ETF, companies do not all have the same weight. Your investment is not divided equally, but rather proportionally to each company's market value. For example, Nvidia currently represents around 7.7% of the total value of the index. This means that a relevant portion of your investment is exposed to that specific company. One of the major advantages of ETFs, which we already briefly discussed, is that if a company no longer meets the index criteria, fails, or loses relevance, it is replaced by another one. This way, the index adjusts over time and the market continues to evolve and grow. In 1990, you could see the largest companies in the S&P 500 at that time. But if you look at today's companies, many of them didn't even appear in the top 20 during the 1990s. This means that 40 years from now, when today's companies lose relevance, they will be replaced by others, and the cycle continues. The S&P 500 ETF has a relatively low cost, around 0.07%, which we already mentioned earlier. Here you can see the S&P 500 over more than 60 years. Despite crashes and volatility, the long-term trend has always been upward. Over the last 100 years, the US stock market has delivered very different results depending on one key decision: whether dividends were reinvested or not. If dividends are reinvested, the stock market benefits fully from compound interest. Historically, this results in a much higher long-term return, even after accounting for inflation. When dividends are not reinvested, returns are significantly lower, not because markets stop growing, but because a key part of compounding is missing. At first glance, the difference between these two approaches may seem small on a yearly basis. Over decades, however, it becomes enormous, and that's where the real impact of compound interest shows up. It may not seem like much, but if you had invested €100 100 years ago and reinvested all dividends, you would today have €2,285,690 without adding any extra money. After adjusting for inflation, this corresponds to a real annual return of around 7.4% per year. Now here's where the difference really shows. If you had not reinvested dividends, the annual return would have dropped to just 6.54%. And over 100 years, that small difference completely changes the outcome. With the same €100 but earning 6.54% per year, you would have ended up with only €56,398. This is the S&P 500. It is already quite diversified, but it is still concentrated only in US companies. That means that if something happens to the United States, it will have a direct impact on your investment. Let's also talk about the MSCI World, which tracks more than 1,300 companies worldwide across 23 developed countries. In other words, it is almost 3 times more diversified than the S&P 500. Even though almost all S&P 500 companies are included in this index, it does not make sense to invest in both indexes at the same time, as you would be overlapping exposure. Some ETFs that track this index include iShares MSCI World SRI UCUTS ETF DIST, iShares Core MSCI World ETF ACC. In terms of cost, the MSCI World has a management fee of around 0.2%. When investing in these ETFs, it's important to look for versions that are traded on a euro-denominated exchange. This helps you avoid unnecessary foreign exchange risk and conversion costs, since you would otherwise be converting euros to dollars every month. If, 40 years from now, the dollar is weaker relative to the euro, that could significantly reduce your overall returns. Over the last 45 years, the average annual return of the MSCI World has been around 10.35%. For this simulation, let's assume that a 25-year-old invests €100 per month, starting with an initial investment of €1,000. And before you skip this because it sounds too small, let me be direct. For most people, €100 a month is not impossible. It's usually just a question of priorities. Almost everyone can manage to live with €100 less per month if they truly decide that building their future comes first. To keep it simple, we will not account for inflation, and we'll assume an average annual growth of 9%. After 10 years, you would have invested a total of €13,000, and you would end up with €21,339.32. At the beginning, growth won't look that impressive, and that's exactly why most people quit too early. But once you let compound interest do its job, the results start to become genuinely impressive. With 10 more years on top, meaning this person is now 45 years old, they would end up with around 69,000 euros after having invested only 25,000 euros. If we let the investment run for 30 years, we start to see returns accelerating. After investing 37,000 euros, you end up with 183,000 euros. And remember, all of this happens by simply investing 100 euros per month without doing anything else. But now is where we start to notice the big differences. In the first 10 years, you make around 8,000 euros in profit. From 30 to 40 years, you add another 240,000 euros in profit. So by the end of 40 years, doing this type of investing, you would have invested about 49,000 euros and ended up with around 453,000 euros. Now let's see what happens if we simply leave the investment working for you for just 5 more years. The total invested would increase to around 55,000 euros, and you would end up with approximately 705,000 euros. Your retirement is basically secured with this investment around the age of 70. So in just 5 years, you went from 450,000 euros to 700,000 euros. That is the power of compound interest and of letting your money work for you. This type of investing is the best possible the earlier you start. I wish someone had explained this to me when I was 10 years old. The best time to invest was 10 years ago. The second best time is now. If I move all my money from one place to another, do I lose the compound interest effect? As with any investment, ETFs also carry risks. However, in the case of well-diversified ETFs, those risks tend to be relatively low when compared to investing in a single company. For you to lose all your money in a global ETF, an extreme scenario would have to occur. We would be talking about companies like Tesla, Amazon, Apple, Meta, or Nvidia losing their entire value at the same time, with no new companies emerging to replace them. If that were to happen, you would most likely have far more serious problems to worry about than your investments, such as a deep global crisis or a worldwide conflict that prevented companies from continuing to operate. A more realistic risk would be the market stagnating for long periods and not growing at the pace it has grown in the past. That is something no one can predict with certainty. Even so, we have decades of historical data showing a long-term upward trend in the market despite crises, recessions, and difficult periods along the way. That's why, although they are not risk-free, ETFs are still considered one of the most robust and consistent ways to invest over the long term. When an ETF shuts down, meaning it is closed or liquidated, this means that the fund manager decided to close it. The manager is the entity responsible for creating and managing the ETF, such as Vanguard or iShares. An ETF can be closed for several reasons. It may have too little money under management, stop being profitable for the manager, be replaced by a similar ETF, be merged with another fund, or simply no longer make sense to keep the product active in the market. When this happens, the process is simple and automatic. You will receive a notification by email from your broker or from the fund manager in advance, usually between 1 and 2 months beforehand. From that point on, the ETF stops accepting new purchases, and the manager starts gradually selling all the positions held by the fund. After all the assets have been sold, the resulting cash is returned directly to your brokerage account. You don't need to do anything manually. The money appears automatically in your account, and from there, it's up to you to decide where to reinvest, whether in a similar ETF managed by another company or in a different type of investment. It's important to understand that in most cases, this process is treated as a normal sale. This means that if there are gains, you must declare them and pay taxes on the corresponding capital gains. In most situations, it is not possible to automatically transfer the value from one ETF into another ETF. Each ETF is an independent product with its own ISIN code, its own legal structure, and different pricing. For this reason, the manager cannot simply move your money from one ETF to another. The only exception is when there is a merger between two ETFs within the same management company. In those cases, your position can be automatically converted into a new equivalent ETF without the need to sell and without paying taxes, because technically there was no sale, but rather an internal exchange. In summary, when an ETF shuts down, you don't lose your money. You receive the value back automatically and decide where to reinvest. And if the ETF is merged with another one within the same manager, the transition can happen automatically with no tax impact. Stocks and ETFs are only reported to the tax authorities when you sell something. Taxes are applied only on profits. and the tax rate varies from country to country. There are two main ways to declare taxes, and those methods can differ depending on whether you invest through a domestic broker or an international broker. It's also important not to forget the income you may receive from distributing ETFs, because those dividends you receive are also subject to taxation. With accumulating ETFs, taxes are usually only due when you sell, since dividends are reinvested automatically. Tax rules can vary and change over time, so it's always important to check what applies in your country of residence. The good news is that taxes are not something you deal with every month, but only when specific events occur. To invest, you need to go through a company that acts as an intermediary between you and the financial markets, which is the stock exchange. You can do this either through traditional banks or through brokers. Brokers specialize in this activity, which is why they usually offer much better conditions and lower costs compared to banks. In simple terms, a broker is an intermediary between you and the financial market. The way it works is very straightforward. You open an account, transfer money to it, and then buy and sell financial products. The broker then holds your assets in your name. When it comes to risk and security, there are a few important points to keep in mind. You should always choose brokers that are regulated by recognized authorities, such as the FSCS, BaFin, or other European regulators. In case a broker goes bankrupt, there are protection mechanisms in place to safeguard investors. Brokers can differ significantly when it comes to costs and commissions. Some brokers charge a commission for each buy or sell order, while others do not. You should also pay close attention to currency exchange fees, custody fees, and inactivity fees, as these can quietly reduce your returns over time. So how do you choose the best broker for your situation? There are many brokers operating in Europe, and choosing the right one depends mainly on the type of investing you plan to do. Someone who invests in ETFs once per month is not the same type of investor as someone who trades leveraged CFDs and places dozens of trades every single day. That's why it's important to match the broker you choose with your investment style, your goals, and how often you plan to trade. On this channel, we've already made a full video comparing the main brokers available in Europe. In that video, we broke everything down using a clear and practical framework based on 8 fundamental points that every investor should look at before choosing a broker. We call it the 8-point checklist every investor must follow. We start with regulation and protection because the first question should always be, how safe is your money really? Then we look at ease of use because a platform that's confusing will eventually cost you mistakes. We go deep into fees and foreign exchange costs, the hidden expenses that quietly kill your returns over time. We also analyze the products offered, especially the difference between real assets and synthetic products. On top of that, we cover transfers, reports, and potential tax traps, which many people completely overlook. We also look at extras and reputation because not all brokers are built to last. We explain taxation and withholding taxes so there are no surprises later on. And finally, we focus on transparency and long-term sustainability because this is a long-term game. So if you want to understand which broker actually makes sense for you, based on these 8 points, make sure to watch that video next. It's already on the channel.